Houston hotel financing, occupancy, RevPAR, and lender appetite. And Houston's hotel market is showing renewed momentum in 2026. But securing attractive hotel financing in Houston requires more than owning a well located property. And hotel lenders are underwriting the operated business behind the real estate. And that means three factors can have an outsized impact on loan proceeds, leverage, pricing, and lender appetite. And those are occupancy, RevPAR, and cash flow. So for investors considering the acquisitions or refinancing or renovation or development of a Houston hotel, understanding how lenders evaluate these metrics can help determine whether a property receives the most competitive financing or struggles to get financed at all. Houston's hotel performance is improving in 2026. And Houston entered 2026 after a challenging period for parts of the hospitality sector, but current performance provides reasons for optimism. Houston first reported that through July of 26, Houston hotel occupancy was roughly about 61% year to date. An average daily rate or ADR increased about 6%, and RevPAR increased about 6.5% to $80. And July itself produced 59% occupancy to 122 ADR, 72 RevPAR, and 8% year over year revenue growth. And the performance was not uniform across Houston either, though. Downtown CBD RevPAR increased approximately 70% year over year, while the medical center increased about 15%. So the distinction here is that it's important for borrowers because hotel lenders rarely underwrite a property based on solely on Houston's wide metropolitan average. They want to understand the property's specific submarket, the competitive set, the flag, the demand generators, operating history, and future outlook. So occupancy, can you consistently fill your rooms? Hotel occupancy measures the percentages of available rooms sold during a particular period. So say, for example, a 100-room hotel selling 65 rooms on average a night would approximately have 65% occupancy. But lenders aren't simply looking for the highest occupancy possible either. They want to know why guests are staying at the property and whether that demand is sustainable. And Houston has a particularly diverse collection of hotel demand generators. And some of those include energy and corporate travel, George R. Brown Convention Center activities, the conventions, the Texas Medical Center, NRG Stadium and major sporting events, Port Houston, manufacturing and industrial activity, George Bush Intercontinental Airport, Hobby Airport, professional sports and leisure and international travel. So a hotel that's dependent on one employer or construction project or sporting event or a temporary source of room demand may receive substantially different underwriting treatment than a property with a more diversified recurring demand set. And historical occupancy does matter, and lenders will typically analyze trailing operating results rather than simply accepting management's future projections. So expect lenders to examine information such as the trailing 12-month occupancy report, but also the monthly occupancy trends over the 3-year set, year-over-year performance, and also competitive set occupancy like your comparables, seasonality and group versus tenant or contract business, but also market supply and new hotels under construction and any PIPs or property improvement requirements. And a hotel performing at 65% occupancy isn't automatically better than one at 60%. The lender just needs to understand the revenue picture. ADR and how occupancy does not tell the whole story. So average daily rate or ADR measures the average room rate achieved on the rooms that actually sold. And this matters because an operator can potentially increase their occupancy simply by lowering their rates. So consider two hypothetical hotels. You've got Hotel A, it's got an occupancy of 70% with an average daily rate of $100. Whereas Hotel B's got an occupancy of 62%, but an average daily rate of $135. Hotel A has greater occupancy, but that does not necessarily mean it's the stronger hotel. And that's why investors and lenders frequently focus heavily on RevPAR. RevPAR, one of the most important hotel metrics. Revenue per available room, or RevPAR, combines occupancy and ADR into one simple performance metric. And a simple formula for that is RevPAR is your ADR, average daily rate, times your occupancy. So suppose a Houston hotel has $140 in ADR and a 65% occupancy. Its RevPAR would be 140 times 65%, or $91. And RevPAR helps lenders evaluate how effectively a hotel monetizes its available room inventory. So increasing occupancy while dramatically discounting your rooms may not really improve your property's economics. And increasing ADR without maintaining sufficient occupancy can also create the opposite problem. So strong hotel operators attempt to optimize both. So why RevPAR matters to hotel financing. And hotel loans are ultimately repaid from cash flow. And RevPAR influences room revenue, which flows through the hotel's income statement and ultimately affects EBITDA, NOI, and debt service coverage, as well as your valuation. And that creates a chain that lenders pay close attention to. So occupancy plus ADR turns into RevPAR, turns into revenue, turns into cash flow, turns into DSCR, and turns into loan proceeds. And weakness anywhere in that chain can create issues. And this is one reason that two hotels with similar valuations can receive dramatically different financing proposals. And Houston's hotel market isn't just one market, and Houston is geographically enormous, and hotel performance varies significantly by its submarkets. So a lender evaluating a hotel near the Texas Medical Center may analyze demand differently. That's one that's underwriting properties near a hotel or a IAH, an airport, or in the energy corridor, or near NRG. And recent Houston First data illustrates those differences. In July 26, downtown CBD hotels were about 205 ADR, 108 RevPAR, while Energy Center and Medical Center hotels are 145 ADR and 84 RevPAR. Different demand generators create different operating characteristics. And hotel investors should therefore avoid underwriting and acquisition based solely on broad Houston hospitality statistics. And your competitive set matters more than metropolitan averages do. Let's also talk about lender appetite for Houston hotels. And hotel financing remains available, but lender appetite is highly property and sponsor specific. And potential capital sources can include banks and credit unions. And banks and credit unions can provide attractive financing for stabilized hotels with experienced sponsors and strong financial statements and sufficient liquidity and established cash flow. And relationship banking can also play an important role. SBA financing. For qualifying owner-operated hotel businesses, SBA 7A and SBA 504 may provide attractive structures. And depending on eligibility and transaction structure, SBA financing can potentially be used for acquisitions in real estate and renovations and equipment and other qualifying business purposes. And SBA hotel transactions require careful underwriting of both the property and the operating business. There's also bridge loans, and bridge financing may be more appropriate when a hotel is undergoing a renovation or has to pay off a PIP or repositioning it, or they're converting their flag, or they're stabilizing it, or there's just a transitional business plan. And bridge lenders generally tolerate more execution risk, but typically command higher pricing than permanent financing. But there's also CMBS and other capital market options, and larger stabilized hotels may have access to CMBS and institutional financing structures. And the right capital source depends on the loan size and the leverage and the sponsorship, and the property performance and the flag and the location and the investment strategy. So what makes a Houston hotel more financeable? And lenders generally become more comfortable when several characteristics align. They want to see sustainable occupancy and competitive RevPAR and experienced ownership with strong liquidity, sufficient debt service coverage, and a defensible business plan. But they also pay close attention to the property's physical condition. And a looming property improvement plan, or a PIP, can materially change the economics of an acquisition. So if an investor buys a hotel for $8 million, but immediately needs another $2 million for renovations and brand required improvements, the lender really is underwriting something closer to a $10 million project. And that additional capital requirement may be incorporated into the financing strategy from the very beginning. And sponsorship can matter as much as the property does. And hotel lending is highly operational. In an apartment building that primarily collects rents from tenants, a hotel effectively releases its rooms every night. So that creates more significant operating volatility. And for that reason, lenders often place substantial weight on the sponsor's hotel ownership experience, the management experience, the franchise experience, but also borrower liquidity and net worth and post-closing liquidity. Are there any management agreements or franchise agreements, and what the guarantor strength looks like? And a strong property with inexperienced sponsorship may have fewer financing options than they expected. And conversely, an experienced hotel operator may be able to attract lender interest for a much more complicated transaction as well. Houston's longer-term hospitality story. And Houston continues to benefit from several structural demand drivers, including population growth and healthcare and energy and international commerce and conventions and industrial development and major sporting events. And business and group travel are also important. In recent 2026 mid-year hotel outlook forecasts, RevPAR roughly 2.5% growth, and specifically identifies Houston among markets that are positioned to benefit from business and convention-linked demand. And Houston is investing heavily in its convention infrastructure. And these factors don't eliminate hotel investment risk, but they do reinforce why lenders and investors continue evaluating opportunities throughout the Houston market. So before making an offer, let's model your financing. And hotel investors sometimes make the mistake of negotiating the acquisition first and addressing the financing second. And for hospitality properties, those two decisions should happen together. So before making an offer, let's consider modeling your purchase price and any renovation or PIP requirements, and look at stabilized revenue and NOI and DSCR and your loan proceeds, and also what required equity you're going to need. And then we can stress test the transaction. So what happens if your occupancy declines 5 percentage points? And what happens if your ADR grows more slowly than you projected? Or what happens if your payroll or insurance costs increase? And what happens if a renovation takes 6 months or longer? And a deal that only works under perfect assumptions isn't conservatively financed, is my point. So the bottom line is that Houston's improving hotel fundamentals are going to create opportunities for investors. But hotel financing remains highly dependent on property level performance. And occupancy tells lenders how effectively the hotel is generating demand. And ADR tells them what guests are willing to pay. And RevPAR helps demonstrate how effectively management converts available rooms into revenue. And then the cash flow ultimately determines how much debt the property can support. So the strongest financing strategy, therefore, isn't simply about finding the lender quoting the lowest interest rate. It's about finding the capital source whose underwriting is going to actually fit the property's performance and sponsorship and business plan and their investment strategy. Are you looking for Houston hotel financing? Well, I'm your guy. Through CommLoan, I can help commercial real estate investors evaluate financing strategies across a broad network of lenders and capital sources. So whether you're considering a hotel acquisition or a refinance or renovation or repositioning or development, the objective is pretty straightforward. Understand the property's numbers first, and then structure the financing around them. My name's Bill Rapp. I'm part of the CommLoan Empower program, and I do commercial real estate financing. Love to have a conversation with you when you have more time. That is it for the day. You can visit my website to learn more, billrapp.commloan.com. Thank you for your time.